Well, I think really it's a question of long income. I think wherever you look, and in a way, I'd almost challenge the idea that London's a safe haven. So maybe start with that. I mean, if you look at the way pension funds have typically looked at the UK property market, London offices would have been anything but the safe haven. That they're the most volatile sector of the market. Although clearly a very big one. I think what's happening at the moment is very interesting. We're seeing a lot of the global money wanting to avoid the Eurozone, so London is an obvious beneficiary of that. What they're looking for is really, I suppose, a store of money over a long time period. And if you're not worried about short-term cycles, then to pay 4% for an office in the West End with relatively limited growth prospects, but with a strong income on a long lease isn't such a ridiculous thing to do. But certainly from a UK pension fund perspective, the very volatile London office market, the volatility is a price that you pay for its transparency, which is what's attracting the global investors. So I think London is two stories. From a UK pension fund perspective, we would be more nervous about putting significant amounts of money into London because of the low yields and because of the likelihood of volatility going forward. So where does that leave us? Well, certainly our approach is that there are interesting opportunities across Europe. I think some of the major capital cities certainly have been mentioned, but the Nordic markets, Norway in particular, has forgotten to have a recession for various reasons. It's a commodities-driven economy. They're small markets, but again, very well understood, very transparent. And then I suspect we'll probably come to talk a bit more about this, but the second-tier markets, the regional cities, there's a broad, deep institutional investment markets in countries like Germany, potentially France as well, although France is more dominated by Paris. And then perhaps the other thing we haven't touched on yet in the UK, which I think is a very obvious challenge, is the state of the retail market. So pension funds typically in the past had about half their UK portfolios invested in retail, a proportion of that in high street retail, and just the value destruction on an unprecedented scale. We understand the reasons behind that. But that's clearly a big issue. So strong regional locations, dominant shopping centres, the very best retailing in a small number of regional cities we think is quite attractive. But beyond that, the real pain, it's not the independent sector, as maybe the Daily Mail would have you believe. I think independent retailers are very good at reinventing themselves. It's always been a dynamic sector. It's the destruction of the multiples and the sort of constant stream of store closures and cuts in those networks. So we have, I think, huge overcapacity in the retail sector in the UK, which is a longer-term struggle. So finding value amongst all of those things, it's really about this long income. It's focusing on where you find that. That's multi-sector and international as well.